Hello, I'm Sean Walters. Welcome to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. We relaunched this show with a simple standard. Every episode should help make advisors make better decisions, lead stronger teams, and serve clients with more confidence. This week, not someday. Today's a market update, part 2, because the macro story just keeps moving, and we want to start the year with a couple of great guests to talk about what advisors should be thinking about as they think about the markets with their clients. Today, I'm joined by longtime Investments and Wealth Institute favorite, Liz Ann Sonders. Hello, Liz. How are you?
Good, Sean. How are you?
Doing great. It's great to see you again. Liz Ann is Chief Investment Strategist at Charles Schwab and is one of the most widely followed market strategists in the industry. She's been known for not just talking about what the market is doing or what the market did, but what it really means and how professionals should respond. Liz Ann, you and I think I started as CEO of IMCA back in 2010, and we had you as a guest to our conference, I would say almost every year for several years there. So you know a lot about our members. So welcome to the Exceptional Advisor podcast.
Well, thank you so much. Thanks for having me. Looking forward to our conversation.
So you know that we're a professional association and we value professional education and credentials, but also we're a community of financial advisors, exceptional financial advisors. So I always like to lead with something a little more personal about you and your start in the investment industry. You know, who helped you kind of get your start in the business? Or what was the moment where you really knew that you were kind of in the right place at the right time?
I think both of those, Sean, happened while I had already started my first job. So there was nothing, say, when I was in undergraduate school that I wasn't being given any particular guidance. My parents were not financial people. I'm the first person to graduate college in my entire family. So really, that when I was in college, undergrad, all I knew that I wanted to do was live and work in New York City. And so that was my initial goal. I interviewed across the spectrum of industries, and I had 2 interviews at this company called Zweig Avatar, and I don't know, something spoke to me, and I joined the firm as a grunt, and then I grew up in the business, so to speak, under the tutelage of the late great Marty Zweig and his founding partner, Ned Babbitt. And so my first job gave me my start, and they were my mentors, and I fell in love with the industry by virtue of just taking a chance on that particular company.
Yeah, that's great. No, it's great to hear those origin stories. So you're known for helping advisors step back from the headlines and focus on what really matters beneath the surface. And that's good. This is a podcast, not a presentation where, the markets are whizzing around us as you're speaking. As you look at the environment today generally, what's one area that feels more resilient than expected and maybe one that's showing real strain? And then if you want to keep going, one that's generating a lot of noise but not a lot of signal.
Yeah, I would say that in terms of where there are pockets of strength and weakness, it really depends on the month or the quarter. This has been an incredibly unique cycle, really going back to the COVID era, where it's been a rolling cycle, rolling pockets of strength and weakness over time. And the benefit of that kind of unique backdrop is that, save for the very short-lived pandemic-oriented recession, we've managed to have these sectoral recessions, these segmented recessions, but in an ongoing broad aggregate expansion. And that's because where we've developed pockets of weakness have been offset by pockets of strength. The first way that manifested itself was in the goods versus services side of the economy, because, of course, services were completely shut down during the early part of the pandemic. When the stimulus kicked in, we still had access to buying of goods. So we had this huge surge in the goods side of the economy, huge surge in inflation in that part of the economy, but we had the just shut down recession-like conditions in services. Then when services opened back up by virtue of the creation of vaccines and the economy opening back up, we had pent down demand on the manufacturing side, but pent up demand on the services side. It worked its way through inflation that way too. We've been kind of in this recessionary backdrop for manufacturing, but maybe to get more specific to part of your question, I think what we may be starting to see now, and I would emphasize may, is finally manufacturing trying to pull itself out of its recession and not quite as robust a backdrop in services. So more of that roll through, both in terms of the growth side of the economy and where these pockets of weakness. It's all has to do with the K-shaped nature, and there's so many facets to that, which we've written about a lot. And I think that kind of roll through backdrop is more likely to persist than not.
Within that, I mean, that's really a nice macro view on the growth piece of that. How does inflation and rates play out for the year? What are your thoughts about that?
Yeah, so I'll give you a big picture thought on inflation and tie it to the Fed's 2% inflation target. Um, in the era that predated the pandemic, the often called the Great Moderation era, from the mid to late 1990s, up until actually within the first 2 years of the pandemic, until the 2022 inflation spike, that was an environment where you could think of, and if you pull up a chart, you could look at it. 2% was almost the ceiling in a range that inflation bounced around in. Now I think we have to think of 2% maybe as the floor in a range that will bounce around. Um, you really have to slice and dice inflation to get the full story. We had the massive differential in goods inflation versus services inflation, courtesy of the pandemic and the aftermath of that. We actually went into goods deflation there for a while until tariffs kicked back in. And since then, we've gone from negative 2% deflation back up to about 2% inflation. So some who will say tariffs haven't had a deleterious impact on inflation might point to that and say that's right around the Fed's target. But the rate of I mean, the direction of travel also matters, and it has been that turn higher. You can also slice and dice inflation in a number of other ways, not just goods and services. You can slice and dice it discretionary items versus non-discretionary items. So it would be the wants components that are measured in inflation statistics and the needs components. And that ties further into the consumer related K and why there continues to be so much pressure on the bottom end of the K, the lower income consumers, because just non-discretionary inflation is running hotter than discretionary inflation. Those non-discretionary items, the needs components, represent a larger share of what lower income consumers have to spend money on. So it's yet another example of data points where you've got to peel at least one layer of the onion back to get the fuller story. You can look at imported goods versus exported goods. There's so many ways to really get a sense of some of the unique facets to this environment and how they're impacting inflation. In the meantime, I think the not trigger, but I think what the Fed is maybe a little bit more focused on as it relates to their dual mandate of inflation and the labor market is the labor market. They've shown us that their decision to either, pull the lever forward or pull it back has been driven more by what's happening in the labor market than on the inflation side of things, barring an extreme move one direction or another in inflation. So I think the Fed is probably on hold. I think at least through the March FOMC meeting, maybe up until Powell's term ends as chair, and we're going to assume Kevin Warsh is installed as chair. So I think we'll continue to have a relatively calm backdrop in terms of expectations for short rates. That doesn't necessarily mean it stays calm by the bond market in terms of long-term interest rates.
So let's pause on that. So if I'm an advisor listening to this, what is the practical implication of kind of that base case, that context you just outlined? Next 90 days, is there anything you think advisors or their clients are most likely to overreact to? Is there anything that you'd counsel advisors to focus on in terms of a lot of the information that's going to be coming and some of the
Yeah.
swings that might be happening?
I mean, great question. I think there's probably what is going to be highly focused on, and I'm not necessarily saying you shouldn't focus on it, it doesn't matter, but, is commentary not just from Kevin Warsh. He's been, he's sort of radio silence
Mm.
since President Trump made the announcement that he was his pick. And I should say, full disclosure, I've known Kevin for close to 25 years. That doesn't necessarily mean anything, but I do know him. I think he's very, very smart. But we'll also concede that he has had a variety of views over the years, and that's what everybody's trying to figure out right now. He's generally seen as a hawk. That was the quick reaction on the part of markets when his name was announced as the pick. But now it's been radio silence. So I think there's going to be a lot of analysis of not only any comments made by Warsh along this way through the confirmation process, but by other members of the FOMC to hear what they might be willing to say about this transition from one chair to another. So I think that type of news could be market moving. It could change expectations for what the Fed is going to do. It could have implications for the slope of the yield curve. And now, of course, as it relates to more recent behavior, anything AI related, disruption in the software space, this broadening out in how we're thinking about AI. We're now in a stage where we're simultaneously thinking about who are the beneficiaries of AI, but where is the disruption going to be felt most acutely? So I've been talking about it in the context of sort of the three C's. We had the create phase, we had the catalyze phase, kind of the build out data centers and energy. Then I've been saying we're in the cultivate phase, but we may also be in a little bit of that creative destruction phase too that is natural when you have a fast-growing innovation and you start to weed through the winners and the losers. And the nature of trading in this environment with the power of retail traders and to not even maybe an equal degree, but an important degree, the big speculators and the commodity trading advisors. Narratives can change and moves within the market can happen so quickly. My advice would be don't try to anticipate those narrative changes and try to trade in advance. I think this is an environment where you would expect to have more frequent bouts of volatility and let rebalancing be your friend.
There's a lot of advisors that like to use kind of a indicator dashboard, so that 60 to 90-day dashboard. Let's talk a little bit about that. Are there any indicators that you would encourage advisors to watch over the next quarter? What might they tell advisors that they should be doing?
So I touched on it already as it relates to the Fed's dual mandate and maybe where their sharper eye is focused. I think it's the labor market data that is going to be key, not just as it feeds into monetary policy decision making, but as it feeds into the consumption side of the economy. Now, that may seem like an obvious statement. Health in the labor market is an important part of maintaining the consumption side of the economy. But I think more acutely now than it has been in the past because many of those traditional supports for consumer spending, like the savings rate or the excess savings that came about from the massive stimulus associated with the pandemic, that's largely been drawn down. There's pretty much no excess savings now. The savings rate, the traditional savings rate, is back to slightly subpar levels, which means that pillar of confidence in the labor market is an important support for the consumption side of the economy. So I think that piece of sort of the economic quilt and landscape is incredibly important. And I also think that the capital spending side of the economy, we've been in this bifurcated environment where anything AI related has been on fire and non-AI related capital spending has been much more subdued. In an ideal scenario, if you get some drawdown in capital spending trends on the AI side, you see a lift. The concern, of course, is if confidence remains dented. And the last thing I'd say to that is it it ties into the consumer, but it also ties into the business community. It's really important in this environment to not just listen to what they're saying, but what's actually happening. That differential between sort of soft data and hard data. Survey-based data, what individual investors are saying versus what they're doing, what consumers are saying versus what they're doing, what businesses are saying versus what's actually happening on the ground. So pay attention to the differential there because the ISM manufacturing report that came out recently was really strong on the upside. We Manufacturing was shown as pulling out of a contraction back into expansion. New orders picked up, employment picked up. But one of the things ISM does when they release those indexes is they provide a summary of verbatim comments from the purchasing managers that they're surveying. You look at the comments, the verbatim comments in the recent release of the ISM Manufacturing Index, and then you look at the headline readings, and you'd think you were looking at two completely different surveys, that they had no relation. Maybe you pulled the comments from some earlier time. And so there again is the difference between where they're really feeling it's sort of the vibe session, but what's actually happening on the ground. And I think we should never look at just one in isolation without tying together what they're saying and what they're doing.
That sounds like that's going to be further part of that recipe for volatility this year
Yes.
when you have two different sets of signals kind of driving things. That's a perfect bridge into the behavioral side, the client behavior. There's, as you know, one of the bigger challenges for financial advisors is managing their clients' fear and uncertainty and their bad decisions. Any advice in terms of with all this volatility that we might expect this year? What's the most effective way for advisors to frame that volatility so clients don't kind of drift into bad decisions?
Probably the first step, and maybe one of the most important discussions that an advisor should have with their client when establishing a plan. And typically, the plan is a function of their time horizon and what their needs are, whether it's short term spending or long term spending, and then in particular their risk tolerance. And that's sort of the financial risk tolerance end of the spectrum. And that a lot of people, a lot of investors will too directly tie time horizon to risk tolerance. I'm younger, I'm not I'm going to I'm going to be working for, 30, 40 more years. Therefore, I should take a more aggressive stance. I have high financial risk tolerance. But then there's the emotional risk tolerance, which can sometimes be completely distinct from your financial risk tolerance. Ideally, what advisors can do is help investors figure out whether there's a yawning gap between those two or a narrow gap before they learn the hard way by panicking at the first, whatever, 15% drop in a portfolio. And they realize, I can't handle this pain. They might still have 40 years ahead of them. That's their time horizon, but that doesn't mean that they're automatically a risk tolerant investor. So I think that's the most important part of the discussion. And then truly going to the disciplines around diversification across it within asset classes, periodic rebalancing, the fact that you can approach rebalancing depending on the environment in different ways at times. A lot of investors will do calendar-based rebalancing. It's a lot of funds, traditional mutual funds do quarterly rebalancing, the last week of every quarter. But there are times where volatility-based rebalancing can help. Basically, it means let your portfolio tell you when it's time to do something. By virtue of more extreme moves across asset classes, within asset classes, and it gives you that opportunity to add low and trim high. When if you solely base it on the calendar, then you're at the mercy of just what happens to be going on right at that moment. Let your portfolio tell you when it's time to do something. So there may be the slightly more boring things to talk about. If I go on, and I love podcasts like yours because they are long form questions where there's the allowance for long form answers. In soundbite television, I'm often asked, okay, Liz Ann, are you telling your clients to get in or get out? And I always think, well, neither get in nor get out is an investing strategy. That's just gambling on two moments in time. Investing should be a disciplined process over time. I love to do jigsaw puzzles. I often will ask an audience of investors, what's the most important piece of a jigsaw puzzle? And hands go up and they'll say the last piece or the corner pieces or the side pieces. And I always say it's the picture on the box. That's the plan. If you try to do a 1,500 piece jigsaw puzzle without looking at the picture on the box, good luck. And I think too many, especially younger retail trader, that cohort, uh, they they threw the box away. And it's just, let's have fun with the pieces. And I think it's really those tried and true disciplines that are key to success.
Yeah, I mean, that's definitely what we teach and test in the SEMA certification, that the picture of the box is the right first step. I wanna touch before we move into the portfolio implications, because you mentioned rebalancing a couple times, and I wanna maybe dive into that a bit deeper. I just wanna touch one bag that you mentioned in the behavioral financial risk tolerance versus emotional risk tolerance. What a great way for advisors to look at their clients and the risk and the way they're reacting to the markets. So I just wanted to kind of double click that one again. That's
Right.
just a nice advisory approach to managing clients through risk, is look at them as two different types of tolerances. That's
Correct.
anything else you want to say on that topic?
Well, again, I think unfortunately, many investors who do figure out that there's a bigger gap between those two than they might have thought learn that the hard way. They learn by I had a Schwab client come up to me at an event last spring. It was in the May time period, and she came up to me and she said, "I've been a Schwab client for a long time. I follow all the research you all put out. I listen to you all the time, and I did what I absolutely should have known I shouldn't have done." And on April 9th last year, in the morning, she panicked and sold absolutely everything. And that was that intraday reversal day to the tune of 10%. So that's just an example where she said, I'm seasoned. I understand this stuff. I listen and read what the experts say. I get it. It resonates about have discipline, diversification. Panic is not a strategy." She said, and then I panicked. So there's an example of somebody learning the hard way.
Yeah.
And so there's maybe ways you can probe with clients based on past experiences, hopefully not epic past experience where they just panic and sold everything at, in March of '09, but maybe other touch points that might suggest that really their gut is going to come into play. It's sort of gut and heart over mind. We know what's the right thing to do, but we're very emotional about our money.
Yeah, and I can give you so many examples similar to that woman, even with my own life. And what I always tell consumer audiences is that's what an advisor is for. Call your advisor when you're feeling
Right.
that emotional pressure.
Sean, another way to think about it is not just decisions one makes on the downside, but just like panic is not a strategy, nor is greed or FOMO or performance chasing. And that's been as much in play, if not even more, in the last couple of years
Yeah.
as the panic side of things. And recent examples would be for the last several months, notwithstanding more recent action, you know, precious metals, gold and silver have gone absolutely parabolic. And during that, that was when I was getting absolutely ambushed with questions. Should I get in? When should I buy? How much should I have in my portfolio? And, the little voice in my head that's been doing this for 40 years thought, these are people that never, ever would have thought about gold or silver, would have asked questions about gold or silver. And the only reason they're doing it is because they see what the prices are doing.
Yeah. Well, let's use that as our bridge then to portfolio implications, rebalancing, asset allocation. There's just so many areas we could talk about if we had more time. Bonds, international equities, just kind of high level. What are your thoughts on what advisors should be thinking about in terms of their asset allocation in 2026? And then maybe talk a little bit more about that.
Yeah,
You mentioned let the portfolio guide you in when to rebalance.
sure.
Talk a little bit more about that as well.
So, one of the things I won't do here on your show, nor would I ever do, is talk about asset allocation with percentages. Um, We have at Schwab $12 trillion worth of client assets. There's no one cookie cutter answer. I could actually have a bird land on my shoulder, whisper in my ear, and saying, "I'm gonna tell you right now with 97% probability what the S&P is going to do, what bond yields are going to do, how international stocks are going to perform relative to domestic stocks." If I then watched the bird fly away, I sat down at a table with 2 investors. Investor A, 25 years old, they just inherited $10 million from their grandparents. They are gainfully employed. They aren't gonna look at the portfolio very often. It's just something that they're gonna let build over time. They don't need to generate income from it. They go skydiving on the weekend, so they're very risk tolerant. Investor B is 76 years old, retired, built a nest egg, can't afford to lose a dime of that nest egg, and they're living on the income generated from that portfolio. One, round it to 100% sort of conviction of what the markets are gonna do. What I would tell those 2 investors is entirely different. So I always say shame on anybody that provides some sort of cookie cuttered answer to that, as if that's applicable to all investors. So I'm gonna speak more generally and almost in the context of sort of within asset classes. So we are a believer in the international is now a diversifier asset allocation thinking. For a long time, talking to investors about why you want to have some international diversification meant constantly having to say, I'm sorry. Now you get to say you're welcome. And we do believe you go in these secular cycles where for quite a few years, US just dominates non US and vice versa. And we do think that when the last bear market ended in 2022, that was a decent chance that we were starting another one of these secular cycles. Not that international every quarter, every year would beat the S&P 500, but that there would be rewards that accrue to your portfolio by virtue of having that international diversification. Within that, though, whether the bias should be more toward developed international emerging markets, that is one of the things that absolutely comes down to where you sit on that risk tolerance spectrum because there is more volatility. There are broader swings in emerging markets. It's a higher risk international equity asset class. So that needs to be taken into consideration. We also believe in the broadening out trade. Right now, anyway, we've seen this incredible move in relative terms by equal weight relative to cap weight, by small caps relative to large caps. We think that has legs. However, that just means diversification inclusive of small caps, inclusive of sort of maybe a combination of active and passive. Not, okay, now we're going to tip this to the complete other side. And every quarter and every month, we're going to see outperformance by small caps relative to large caps, equal weight relative to cap weight. But that this is an opportunity to have more diversification. Correlations have come way down. Dispersion is much higher. And not just broad dispersion, but dispersion within asset classes, even within sectors, even within previous, cohorts of great attention like the Magnificent Seven. Massive dispersion even within that. So another message about how to think about portfolios is this is not an environment where you want to put on your monolithic lens and say, "Oh, I just buy the Mag 7 and I'll do well," or "I just buy the S&P and I do well," or, pick a sector. Still one of the most common sets of questions that any of us in our business get, I'm sure you guys do, and you're the people you're associated with, is, "Okay, what sector do you like?" That to me is not a piece of advice that means a whole lot, especially in an environment of higher dispersion and lower correlations. I think we're starting to see a more level playing field between sort of the rest of the market and the mega cap leaders, between equal weight and cap weight, between passive management and active management, and I think that's a good backdrop.
Yeah. And on rebalancing then, do you see anything that was particularly triggered that the need to rebalance based on what's happening in the market?
Uh, Precious metals,
Yeah.
you know,
Okay.
You just do the math, even if gold had started maybe as a 2% in portfolio, which tends to be, and we don't have at Schwab gold as a formal component of our strategic asset allocation models. We never have. But you usually hear somewhere in the 2 to 3%, yes, as a diversifier. The parabolic nature of those moves, especially if you added silver into the mix, would have taken that allocation, assuming you were sticking by some sort of framework, asset allocation framework. The same thing would have happened as it relates to concentration in the portfolio. I've been saying for quite some time now, really going back to the beginning of 2024, when we really started to see the acute concentration problem associated with cohorts like the Magnificent Seven. And there's no reason not to pare things back as they're going up, and that's gets to the emotional side of things. That's where we have to sometimes get out of our own head. A great example of this concept was an actual conversation that I was only peripherally part of. I was in the room, I was sort of listening to it, but a colleague of mine was talking to a client at an event at which I was speaking. And the client had been a long time, was still an employee of an NVIDIA and had a very large concentrated position for obvious reasons. And he'd been working with his Schwab consultant. And he said, my consultant was telling me for a while now, trim 10% of the position, trim 10% of the position. He said, I fought him, I fought him, I fought him. I finally split the difference and I trimmed 5% of the position. Um, and then the stock proceeded to go up 20%. And I'm so not happy. To his credit, my colleague said, would you really have been happier if the 95% you still owned had gone down 20%? Because if you would have had some in your own head bragging rights of, boy, I nailed the trim at a high. Or should you be happy that the 95% of the position you still own is now up another 20%? That's sometime, and to his credit, the client said, you're absolutely right. Of course, that's how I should think about it.
Yeah.
So, same thing had just happened, but it was framing it in a different way. So, rebalancing that act of paring back where there's been outsized gains, adding, it's a version of buy low, sell high. By version, I mean buy low, sell high often suggests sort of all in, all out. It's add low, trim high, and it quite often goes against what, when left to our own
Yeah.
devices, we tend to do.
All right, so I'm going to just wrap up this portfolio piece with, three rapid fire thoughts that you might have on three different topics. I'll tell you all three so you're not shocked when I hit them.
Okay.
The first is going to be bonds because there's been some interesting stuff going there,
Mhm.
alts, and third is going to be crypto. And so
Well, the
you want to talk about crypto
I
first?
don't cover it.
Yeah.
It's not my area.
Yeah.
I have generally been a skeptic. I'm always first to admit that. At Schwab, we hired a gentleman named Jim Ferrioli. He's our crypto expert.
Yeah.
He's starting to publish.
Hmm.
I now blissfully get to figuratively phone a friend
Yeah.
when I get the crypto questions. Alts, I'm not an alts expert. I don't cover them. I would say the most important thing for investors when looking at alternative assets, whether it's private equity or private credit or private real estate, is understand how it fits in your portfolio. Understand the differential in terms of liquidity and transparency. What is it? What is your aim? Is it to be a diversifier? Are you comfortable with lower transparency, less liquidity? So it's really just understanding what are the goals of adding this into the mix and truly understanding both the risks and the opportunities.
Yeah.
So bonds, Kathy Jones is our chief fixed income strategist. She has a phenomenal team. We're all on the same Schwab Center for Financial Research. So I'll parrot a little bit the views of the fixed income side because it's not my bailiwick on a day-to-day basis. Um, we think that there's sort of a quality bias. So we do like the higher quality areas like treasuries and investment grade corporates. For those on the more aggressive end of the spectrum, there are opportunities in some places in high yield, even in areas like emerging market bonds. But again, that has to be in the context of a risk assessment. We think there have been lots of opportunities in munis, but that's obviously very client specific in terms of the benefit of owning munis. And the last thing I'd say is probably even more important within fixed income versus, say, just the equity side of your portfolio is that personalization. It's really there. I think there's most certainly no cookie cutter structure in a portfolio for individual investors as it relates to the fixed income. Even just as simple as it a taxable account and non-taxable account. Is your goal income generation, capital preservation? Is your goal for it to represent a diversification component? And then if that's the case, relative to what? What are you trying to diversify? So I think the customization is even more important on the fixed income side as on the equity side.
Yeah. Okay. Good. Well said. So let's land this plane. That we do ask one final question of each of our guests. And since we're Investments Wealth Institute Association of and for advisors, what's one piece of advice that you'd give advisors today?
Some of them I already touched on. Get in, get out is not an investment strategy. Understand the difference between financial risk tolerance and emotional risk tolerance. But maybe one I would also bring up, it's a adage I've been saying for my 40 years doing this. And I think it's not understanding this trips investors up. Um, Better or worse often matters more than good or bad. And specifically, I'm talking about the relationship between data, what's going on in the economy, a jobs report, a retail sales report, earnings season. Um, Better or worse, direction of travel often matters more than level. And I think it's human nature for us to, when a report comes out, when an earnings release comes out, to think, was it good or was it bad? Was it strong or was it weak? But the reality as it relates to the connectivity between data and the market is better or worse often matters more than good or bad, and especially at inflection points. When things stop getting better and start getting worse, at the top of that V, in level terms, the data is still pretty darn good. But the market tends to sniff out, it's not getting better anymore, it's starting to get worse, which is why the market is a leading indicator, which is why it tends to sniff out recessions in advance of recessions happening, because it looks for that inflection point when things stop getting better, start getting worse. Same thing happens in the other direction. And I think that's
Mhm.
what investors miss often because they tend to think in level terms, not direction terms.
Yeah, that's great advice. That's a great note to end on. Thanks for joining us, Liz Ann Sonders.
Thank you.
So wonderful to talk with you again. And
My pleasure. Thanks for having me.
to everyone listening, if you found this useful, follow the Exceptional Advisor podcast. We'll be releasing at least one new episode every month. And, if there's any other information we can help you with as a premium advice professional community, then please come to us as well. I'm Sean Walters, your host. Thanks for listening, and we'll see you next time.